Good afternoon. Hi, Michelle. How are you? It's good to see you.
Good to see you, Katie.
So Michelle Bobart is a top loan originator with Guaranteed Rate. She's a good friend. She's fantastic at what she does. And she and her team have been computing a lot of numbers these last, especially several weeks with the swinging rates. We're going to spend a few minutes today just talking about how the mortgage market is acting today and some considerations around that, just a whole notion of perspective on the market and how you're advising your clients and the agents you work with in what we're seeing some swings out there now and what you're telling people. So let's just kind of get started and have a conversation around that.
Absolutely. Yeah. So, obviously we have seen quite a jump in the rates since the beginning of the year, especially comparing where we were last year with this year. So just looking at conventional Fannie Mae, Freddie Mac financing, we were looking at rates in the threes, and we have literally jumped up almost double. As of last week, we were trending in the high fives for a conventional 30-year fixed. The good news, the bright light, is we've actually we've moved into mid five. So what's important to know though, when you look at historic charts, we were the last couple of years of the pandemic, we were at historic 50-year lows. But if you look at the spectrum over the last 50 years, if you go to FreddieMac.com, you'll see that tracking over the last 50 years, and you'll see historically we are still in lower territory. So, many folks have, parents or family members that they'll say, hey, I remember when rates were in the teens, all the way to 18%, which was more like a credit card rate. So the good news is we are still in lower territory. The other good news is that when you look at historic charts on where interest rates trend, one of the things that the key indicators in all the economic reports right now is we are heading into recessionary times. When you look at the historic charts of when we go into recessionary times, mortgage rates historically take a dip and they go down. So, we've just had so many unique factors this year. One of the things that's, had a lot of weight is the Russia-Ukraine situation. So we really are anticipating rates to simmer down a bit, come back, say Q1, Q2 of next year in the next 12 months. So what does that look like? What am I advising clients right now? One of the things that I am taking a look at, especially many of my clients tend to move around every 5 to 7 years. So we're also looking at ARM products as well as the 30-year fix. We're making a comparison. So the two most popular that I'm looking at is the 7-year ARM and the 10-year ARM. So the rate is fixed for 7 years. On the 7-year, same with the 10-year, the rate is fixed for 10. So if we're anticipating a dip next year, these are great products, entry products to get yourself in the home, keep the payment down a little bit. But ARMs are many times lower interest rates, but not always. So it's important. Every client's situation and scenario is different. So it's great to do those comparisons. And those are the three most popular products we're reviewing just, as we look at a client's short and long-term goals.
So I'm going to ask a couple of questions. And I was actually out with buyers today, and I use the word perspective a lot. But firstly, we know that home ownership, you've got to live somewhere. So rents are going up, and oftentimes and sometimes trade-up buyers or first-time buyers, there is a deadline. They've got to make a move, or they want to make a move for a lifestyle choice, and it's a positive, wonderful thing. We're here to help them, and so perspective is important. So the question I'm going to ask is just to give us some perspective on numbers. What does the rate? Let's take it rather than a year ago. Let's take it from 5% to 6% on a $500,000 loan. Typically, what does that impact dollar-wise per month? Do you have a range you can give me just so we can?
Well, I think what's important to look at just from, everybody's, again, price point, loan level, what we're deciding is different. I think you bring up a really great point. Rents are through the roof right now. And so when I'm comparing actually with clients, one of the things super important to look at, not only like what's my monthly payment going to be, so comparing it against your current interest rate, you get a huge benefit from home ownership. You're throwing your money out the window every month in rent. You'll get appreciation when we look at the charts. everything's about supply and demand. And we still, as a country, are short on supply. So we've experienced double-digit appreciation nationwide in the last couple of years. This year, I think they're estimating about 7%, the following year about 5%. So prices are only going to continue to go up until we level set with supply and demand.
Yep.
And that they don't believe is going to happen for the next 5 years. So what I'm encouraging clients to do is, as long as you can afford the payment right now, you run the numbers. Again, look at all the ARM options and the fixed product, decide what's best. As long as you can afford it, then we have so much upside. We can, look to refinance over the course of their loan. But then they're getting in, because if you look at it, if we have another 5% stair step appreciation, the home's going to be that much less affordable next year. So, I really am encouraging them, and they can afford the payment now. We don't want them to, be, uncomfortable, with their budget, but as long as it's in that range, then to move ahead, because we still have appreciation that we're working against us. So that's my encouragement.
Absolutely. And so, just kind of wrapping this up, obviously, a lot more about where things are trending than I, but I'm certainly out there and on the field, and I'm saying the same thing you are. And then connect with your lender, connect with Michelle, connect with me, understand your options, and keep in mind that you can refinance. So when there's an opportunity, when there's a rate drop that's significant enough to really have an impact on your monthly payment, that's when you refinance and you lock it in a better rate. So anything else before we wrap up?
Yeah, no, I just, one of the other things that I get often is, just concerns, is it going to be a repeat of the housing bubble of 2007? Everything says no. We had twice as many homes for sale in 2007 than we do today. We have 12 million more buyers. Millennials are in family formation mode. Yep. Many of them have held off on buying a home, so they're buying for the first time. And so they're taking from our inventory. Move up home buyers deposit a house back in the inventory, and then they take. So it's a neutral wash. But so we have just got a lot of folks starting families. They need homes. They're not going to rent forever. So just think it's important that, that we know that, we still are going to be a couple of years before we start to the supply and demand to catch up. So.
Absolutely. So wonderful. Well, thank you so much for your time. It's great seeing you as always. And get back to computing those numbers, and we'll talk soon.
Take care. Bye.
Take care. Bye-bye.